Welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. This is the show where we talk about your mutual fund investments, tell you what's happening in the industry, and speak to the top experts so you can make the smartest choices for your investments. Now, the topic for today is an interesting one. It's talking about redemption. We are constantly talking about, and the information you're constantly getting is about investing into mutual funds, and we know that these numbers are increasing month on month. The latest SIP figures, SIP figures for the month of Jan have crossed 18,000 crore rupees. But is it always one-way traffic? Should you redeem, and if when? Now, the trigger for this conversation actually has come from some interesting data highlighted by one of our experts on the show today, Arnav Pandya, founder of Money Edu School, and Pankaj Mathpal, founder and CEO Optima Money Managers, are with us on the show. And Arnav highlighted how your outflows for SIPs in December were at the highest level in at least the last 6 months. I'm just going to pull up that data to set the context for you first on why we're talking about this today. So, for example, in July 2023, your SIP outflows, and of course, you had massive inflows as well of 15,000 crores in that month, but your outflows were 9,751. Now, cut to December 2023, and that's the data which we have with us publicly available. 17,000 crores, 17,610 crores were your inflows, but your outflows were 11,141 crores. Now, there could be a number of reasons for this. Remember, markets were at highs, at peaks towards the end of the last year, so maybe people felt it was a good time to redeem. But we thought it's an interesting question to address as well. When should you be redeeming your mutual fund investments, if at all? So let me begin with that basic question to Arnav first. Arnav, there could be n number of reasons why your outflows were high in December, but is it safe to say that when markets are touching new highs, there will always be temptation to take some money off the table?
There is a tendency for people to do a little bit of profit booking, especially when markets show a sudden jump. Because if you see in December, there was one very important catalyst which happened, and that was the election results of the 5 states which came in. Now, following that, what you saw was a massive FII inflow, which normally doesn't happen in December. Normally, you find that December is like slightly less activity month as far as the institutions are concerned, and then in January, after the new allocations start coming in, things pick up. But because of this election result and what the market analyzed in terms of the impact on the Lok Sabha polls for 2024, you saw a massive change, one in terms of sentiment, two in terms of the ways the FIIs behaved. So that pushed the market up. And I presume that there is always and some element of redemptions which will be coming in. But the sharp spike or the difference which you see in the month of December is probably due to the fact that a lot of investors also thought that I might as well do some profit booking, because this sudden rise is like an event which I need to cash on.
That's possible. That's possible. And maybe it was a good decision, maybe it was a bad decision. That's very individual. But having said that, Pankaj Mathpal, let me come to you on that broad question that we're asking. Now, I'm sure you get a lot of questions. Should I redeem? And I'm hazarding a guess, but your standard answer must be, don't remove the money unless you absolutely need to. Should that be always the case? If you have been a patient and a disciplined investor and you see these kind of opportunities, should you then leave the entire portfolio untouched?
Now, exactly what you said, that if you don't need money, then don't redeem. That is what I believe in. Second thing, what Mr. Arnav said, I fully agree with him that this time, this looks like a profit booking only, no other reason. Usually we have seen when there is a rally or there is a crash in the market, in both the cases, investors start redeeming their funds. So this time it is a profit booking. But the question is that whether they should book profit or no. Tamanna, it is very simple answer. If you have set your financial goal and you are investing for that, so you should stay invested until you achieve that goal. Because if this kind of opportunities will definitely come on your way. But if you keep on booking profit from time to time, then it may delay in achieving your objective. See, if you feel that your portfolio has grown by 20%, 30%, and you are booking profit, then how your investment will double? So if you let it grow and it enjoys the benefit of power of compounding, then only you will be able to double or triple or multiply your wealth. Second thing, the question when to book profit or when to redeem units. See, one thing is very simple. If your investment is not uh, able to achieve your objective, or you realize at any point of time that you have invested in some schemes which are not as per your objective of investment, risk appetite, or your investment horizon, it is not matching with the investment scheme. That may be one reason that when you realize that this is not the right scheme or suitable scheme for you, you can redeem your investment. Second thing is that you invested for some goal, but in between there's an urgent need of money. That may be another reason you may redeem units. Or there may be a reason that there may be a change in financial attribute of the scheme. In that case also, you may miss when you started investing, at time the scheme was suitable, but now you find that scheme is not suitable for you. You may decide to redeem at that point of time also. So that can be another reason. But otherwise, I believe that if your financial goal is aligned with your investment, you should stay invested. Or one important reason can be rebalancing portfolio. See, suppose you decided your allocation in equity and debt should be 50-50%, but this kind of rally, because of this kind of rally, your allocation is now say 70%, 30%. In such case, also you can rebalance your portfolio. For that reason, you may switch from equity to debt, or if required, from debt to equity. That can be another reason. Otherwise, I believe that one should stay invested till the goal is achieved.
Okay, so stay invested till your goal is achieved. Don't get distracted with what happens in the interim. Arnav, what would you say to this question? What are the top 3 reasons which justify a redemption? And is what we saw in December one of them?
So the 3 top reasons which I feel is: one, you need money for some purpose for which you do not have liquid cash. So at that point, instead of taking a loan or borrowing, it is always better to redeem. So look at the circumstances and then decide whether the expense that you need is important and it cannot be financed through, or it need not be financed through a loan. Second part is that when you need to rebalance your portfolio, because if you look at the markets, you see what has happened in this kind of rally. The small and the mid caps have run up at virtually 40-45% in a year. And it is very likely that most portfolios will see some sort of imbalance as what it was initially constructed. So at that point of time, if you are rebalancing to ensure that both within asset classes, between equity, debt, gold, etc., you are rebalancing, or even within the equity portfolio, if you want to rebalance between various weightages by market cap, that is the second reason why you should do it. And the third and final reason is that your goal is achieved and you want to use the money for the specific goal. That is when you should be redeeming the money. Otherwise, the whole benefit of, see, years long investing, the point here is that the outflows which we have mentioned are going in from the folios where there is also a regular investing going on. So idea for regular investing is to slowly build your wealth and not rely on market timing. Now, if on the other side of the transaction, while you are trying to sell something, you are trying to rely on market timing, then it goes against the principle which you are following. So that is why one should be careful and have a specific reason for taking the money out.
So to explain it simply, if you need to take a personal loan but have a good, mutual fund investment, you may as well not pay a high interest rate on personal loan, and you could then redeem some of those investments for what you need. But you have to be judicious about it. Now, having said that, there are some cases where there is an unusual run-up. Now, Pankaj, let me come to you on this. Last year, for example, small cap funds broadly gave superb returns. Now, this entire year, there seems to be a consensus that you may not see the same level of returns. You had, in some cases, a 40% return on some certain small cap funds. In that sense, wouldn't it make sense to, reallocate at least, redeem and then push in your investments elsewhere?
Exactly. This is rebalancing again within the asset class. See, in equity only, you realize that small cap have outperformed large cap, and you wanted to have a percentage allocation in small cap. So you should definitely rebalance your portfolio. In that case, you can redeem from the small cap or mid cap to invest in large cap. But many times we have seen in some sectoral funds or thematic funds, unexpected rallies there, and you have gained a lot from there. So in that case, also you can rebalance your portfolio. So this can be one reason for redeeming your units.
Arnav, let me take that question to you. You mentioned rebalancing broadly, but let's go into a bit of detail. If you have seen huge run-ups, should you stay cool and calm, knowing that perhaps you won't see that same kind of a return going forward, and believe in the long-term picture?
No, that much is certain. See, whenever you see any category of funds showing abnormal returns, and when I say abnormal, anything above 15, 16% qualifies as abnormal. So if you are seeing 40, 45% return, one thing is certain that this is not a sustainable return. You might see it for 1 year, maybe 2 years, but not for very long because the market goes through a cycle. So that is one point. The second thing here is that one needs to make a distinction between getting out of a fund completely and reducing your exposure to nil as compared to just rebalancing in terms of taking money from one area and putting it into the other. Because what happens is that when you look at your portfolio overall allocation, you, according to your needs, you need it to be in a certain way. So if that entire balance is changed, you need to bring it to where you actually want it. And which is what the rebalancing part is, that you shift money from one place to the other, either between asset classes or within equity itself. And which is where that shifting a little bit of money comes into play. Now, the third question here is that when do you do this? You do not do this just because markets have run up. There should be a specific time period wherein you have fixed at which point the entire portfolio is reviewed, and then you make these changes. Now that brings a little bit of what you call scientific process to this entire thing, and which then justifies the fact that you are taking some money from one area and allocating it elsewhere.
Absolutely. So keep that in mind when you're redeeming. Don't get trigger happy with your mutual fund investments. And perhaps some people, we don't know the details, of course, because these are cumulative figures and what individual decisions were behind it is not very clear. But a large number of people clearly decided to cash out. That's not necessarily the best strategy unless you need the money. You may as well not borrow it, use your investments or put your investments to good use. All right, this is the part of the show where we address your queries. If you want to send in a query to us, you can contact us on any of our social media handles. Those numbers will flash on your screen as well, and we'd love to hear from you. So let's begin with what Vipasha Dubey has asked us. Vipasha Dubey is aged 51, and her query is that she wants views on the ICICI Pru Infrastructure Growth Fund in the form of a SIP. She's looking to invest 10,000 rupees a month for 3 years, considering the government impetus on infrastructure. She says, I'm currently investing in large cap equity funds. So great question there, Vipasha. Thank you so much for sending it in to us. I'm coming to Pankaj first to answer this query. And it's a really good one, Pankaj, because infra is the big theme. And you've seen a lot of funds launch infra-themed funds as well. What do you make of her specific query, and is it wise to invest in a specific infrastructure themed fund?
See, it's a thematic fund. So any point of time can see that different sectors, different themes can outperform the broader market because of government's policies and situation, this looks a good theme. So this viewer can definitely invest in this fund. But because the fund is good in this category, you see, this is a well diversified within this theme. There are around 54 stocks and spread across 12 sectors. So it's not a very concentrated uh, portfolio fund. It is a well diversified within the theme. But as I said, any theme or any sector can outperform the broader market for a certain period of time. So if she wants to invest for next 3 years, this can be considered as a good fund. She can definitely have allocation, but she should review the fund's performance and the theme. And as soon as the themes plays out, she should exit from this and should invest in the diversified fund.
All right, but when will you know that the theme has played out? You know, this segues very well with our previous question. You're just assuming, I mean, no one, if I was the biggest expert in the market right now, do you know when the investment theme will play out? Nobody knows. It's linked with the India growth story.
I agree with you, but suppose government has some higher allocation in defense sector, or they are focusing on infra or capex. So this gives you some indication that these sectors can do better than the broader market. But otherwise, I agree with you. It is very difficult to know, and that is why the retail investors' suggestion is always that they should invest in diversified funds so that fund managers will take the call in this sector they should allocate more. But because her question was very specific and she seems to be positive on this sector, and this is the thing that I also agree that this sector has, or this theme has potential to deliver better returns than the diversified fund for this point of time. So that is why I said that she can consider. But I agree with you, it is very difficult to understand that this sector or this theme will do better than others.
So it's a bit of a risk with thematic funds. Arnav, what would you advise Vipasha?
See, I want to make two big distinctions. One is a good fund necessarily might not be the right fund for you. So, looking at her portfolio, I mean, where she has just exposure to large cap funds, my solution would be that, I mean, you go across the market cap, but stick to diversified funds. Do not go for a specific theme. So the fund is good, but is it right for her? According to me, in that sense, the answer would be no. The second point is that, see, markets always run up ahead of expectation. So if you look at this fund, the 1 year performance shows some 60% return, the 3 year performance shows 40% compounded annual return. So the question also is whether all these thoughts about the infra boom and all is already baked into the prices, because markets always run ahead of the actual happenings. So in that sense, it's also not very clear and nobody knows about this, because this again becomes a question of market timing, which nobody is sure about or nobody can predict as to whether the gains are already there in the portfolio holdings. So which also increases the risk for the investor as well as for a portfolio like this, where a thematic fund can cause a bit of imbalance also.
Okay, so yeah, maybe you need to look at your entire portfolio first. Another question coming in from Vikram, and it's an interesting query. Remember, if you want to send us queries, the WhatsApp number's on your screen. So he's age 33, and the query is, how can a retail investor identify if a fund follows growth / value / gap style of investment? You know, very specific and interesting query there. He's mentioned his current portfolio with a horizon of 25 years. He's only 31. So Navi Nifty 50 Index Fund, he's putting in 15,000 rupees a month. Kotak Equity Opportunities Fund, also 15K a month. And Tata Small Cap Fund, also 15,000 rupees a month. Arnav, why don't you fill that first?
So one way to identify actual manner in which a fund manager manages a portfolio is by looking at what are the kinds of stocks which he or she is including in the portfolio and the way it is managed. Now, as far as one of these components go, value investing, there is a separate category of funds which follow the value style of investing. So that part is simple. But even apart from that, there are many other funds where they follow this style, even though they are not necessarily value oriented funds. So looking at the portfolio and trying to understand this, that is the main way in which one can actually find out which style the fund manager is following, but that requires a little bit of skill, expertise, which a lay investor might not have. So that might be difficult for an investor to do. The second part is with respect to the existing holdings which the investor has. Now, if you look at it, there is one large cap fund, there is one large and mid cap fund, and there is one small cap fund. So if we break up the uh, exposure, then a very large chunk of the exposure is to the large cap, followed by small caps, and the mid cap is very small because within the large and mid cap fund, the mid cap exposure is close to 40%, and the remaining is mostly in large caps. So again, when a portfolio is being constructed, one needs to look at and maintain this kind of internal balance, because large caps are steady, consistent uh, uh, companies which grow their profits in a particular manner, while small caps are more volatile in nature. So ideally, what this portfolio would need is a little bit of rebalancing towards mid cap, away from small caps.
Okay, so more mid-cap away from small cap. I have no time to take that question to you, Pankaj. Unfortunately, I have to wrap. But yeah, thank you to Arnav and Pankaj for joining us today, taking all our queries, and of course, the important question of where to and when to redeem. If you have queries, reach out to us. The WhatsApp number's on your screen. Until the next time, looking forward to seeing you again, and thank you for watching.